How's it going, friends and family? My name is Amos, and I wanted to let you know something. So back in July, I opened up a position into Salesforce, ticker symbol CRM, and they were roughly $2.57 a share when I bought into them. And after dollar cost averaging into this company for the past 2 months, I'm pretty much flat on my investment. And it's a company that during their heyday, they used to trade for about $361 a share at the end of December of 2024. What the heck happened? In this video, I'm going to try to figure out if I should panic sell, get rid of this company, or if I should double down on my CRM investment and continue to dollar cost average. And to do that, I'll go over their recent business news, calculate their inherent worth, like how much should their stock price be right now based on their fundamentals and their numbers, and I'll even address their stock-based compensation, and my game plan will be at the end if you're interested on what I plan to do ultimately. So what exactly is Salesforce, the company? Salesforce is a software company that helps businesses keep track of sales data, HR information, and data visualization with Tableau. They do a lot more than that, but in one sentence, that's how I would describe this company. And by the way, I just want to let you know that last night, dude, I only got 3 hours of sleep. So I'm running pretty low on energy, and that's because my wife's currently 8 months pregnant, and her bedroom, dude, it was like 50 degrees. And I'll tell you what, it's super hard to sleep when you're shivering your balls off, but it is what it is. Despite the low energy, I'm still very excited to make this video. Anyways, let's go ahead and talk about the recent news surrounding Salesforce. Salesforce just posted their Q2 2026 numbers, and it was just flying colors across the board. It was awesome. And the leadership team, I tuned into their earnings call. The leadership team was absolutely bullish from start to finish. And they even increased their guidance for the rest of the year. And I think for me, what was most important was hearing how confident the leadership team was of their road ahead. They're not scared. And in fact, they were very excited with the disruption of AI in their space. And what you see on your screen right now are all the various companies that have posted very positive results because of their integration of Salesforce products. However, Wall Street remains skeptical and bearish. And to me, it doesn't make any sense because as you look at their results, their top line, their revenue went up by 9% year over year. And every category of their business went up by a pretty healthy number, except probably the marketing team. And what's crazy is that they generated $605 million of free cash flow in the past 90 days leading up to their earnings. And they also bought back $2.6 billion worth of shares. And the good news just goes on and on. So previously, their free cash flow guidance was going to be an increase of 9 to 10% year over year. Now they revised it, and now they're saying, hey, we can go up by 12 to 13%. Same with the non-GAAP diluted EPS. However, for the GAAP accounting standard, then it's going to go down ever so slightly. However, if you take a look at their top line guidance, previously, it was 41 billion to 41.3. Now they're raising the minimum standard because now they're expecting the worst case scenario to at least go up by $100 million. But that's for the full year. If we just look at the next quarter, then they're expecting their revenue to go up by 8.5% year over year, and their non-GAAP EPS to roughly be $2.85. So as you can see, the current landscape that they're operating in, things are going pretty smoothly. So now let's go ahead and calculate an inherent worth for this company. Like, what should their stock price be? And the first thing that I want to take a look at is the discounted cash flow analysis model. So predicated upon their free cash flow and the growth thereof, what is their stock price going to be in the future? So what you see right here, I posted the actual numbers that they generated. And so when you factor in for the past 6 years, the growth of their free cash flow has been 28%. However, for my calculation and forecast, I always like to shave from the reality and plug in safe and conservative numbers because it's always better to be safe than sorry. If you plug in optimistic numbers, then you'll get a valuation that's too good to be true. However, if I stay grounded and I plug in cynical numbers, then I'm looking at it from a worst case scenario. And so if the projected stock price is higher than they are right now, then they're certainly undervalued. At least that's how my brain is wired. So instead of 28%, I went ahead and plugged in 10%, meaning their free cash flow for the time being is going to grow 10% year over year instead of what the data says of 28%. Now, if we play with that assumption, then their DCF price is going to be roughly $335 a share. Right now, they're somewhere around like $247, maybe even $250 a share by the time you watch this video. They're certainly far from that number. However, if we plug in a number that's closer to what they are generating, such as like 25%, then their DCF price should be $672 a share. And if we do, I don't know, like 15%, then we're working with $425. However, I'd rather be safe than sorry, so we're gonna go ahead and assume the following of 10%. And so for me, the fair value based on their free cash flow is $335 a share. So $335, the free cash flow perspective. But what about their bottom line per share perspective, otherwise known as the EPS? Well, if they do in fact finish out the year with the low estimation from the analyst and from the company itself at about $6.99, then with a PE ratio of about 35, then they should finish out the year in theory at $244 a share, which means they're roughly in line with where they should be right now. However, if they do in fact close out the year at a PE ratio of 50, then they do have the potential to hit $349.50 a share. Now, as a reminder, what you see on your screen right now is the earnings per share guidance that the company gave itself, and I used the bottom number. Not the $7.03, which is optimistic. We're going with $6.99. And something else that I want to call out is right now we're looking at financecharts.com, the historical PE ratio. What's the trading multiple for Salesforce on a historical lens? So comparing Salesforce to themselves. For the past 20 years, on average, their PE ratio is usually a 91.6. But if we zoom in and only consider the past 5 years, then their PE is usually 152. And as you can see, right now, their PE is a 35. But it gets worse, because if we pull up CRM on our screen and take a look at their forward trading multiple, this company, for what they are doing and the numbers that they are posting, their forward trading multiple is a 20.6. That's pretty darn bearish in my opinion. And in a historical lens and perspective, that's probably the lowest valuation that they are hitting on a consistent basis if we take away the pandemic sell-off of 2020. And then of course the April sell-off that happened in this year. They usually trade for a premium, but right now, friends and family, this is pretty crazy. So if we jump on back over to our EPS forecast to figure out what price they're going to be in the future, hypothetically, in 2026, as you can see by this chart right here, the low estimation is that their EPS, their bottom line per share that they're going to generate is $10.94. I'm assuming that they're going to be able to grow their EPS from $6.99, 50%, to hit $10.49. Yes, right now, the name of the game for Salesforce, not only are they growing their top line at a very aggressive rate, but they're also maximizing their margins and their profits per share. So even though 50% sounds ludicrous and ridiculous, in actuality, the growth rate of their EPS should be closer to 60 or 65%. I shaved off a crap ton, and I'm posting $10.49, even though the low expectation is $10.49. Just digest that for a second, okay? If that happens and they finish out the year 2026 with a PE ratio of a 34, then Salesforce should be $356 a share, and pretty much in line with the free cash flow analysis number that we saw earlier. So somewhere between $335, $350 a share. And if we continue to plug and chug very bearish numbers of their expectations of the EPS going forward, in 2027, the low expectation for their EPS is $11.92. Right now, I have the projected EPS is $12.58. So if I shave it off a little bit and say 15% and say $12.06, which is still far below the average expectation, then at a trading multiple of a 33, Salesforce should in theory be $397 a share in the future. Best case scenario with a 48 PE, they should be somewhere around 578. If we play that game one more time and we jump over to 2028, the low expectation is 1328. Right now I have the growth rate at 15%, but let's be very bearish. Let's be cautious. If we see something like, 11% growth in their bottom line per share, then they're going to be posting $13.38 in their EPS, which is slightly above the low estimation. Then Salesforce with a PE of 32 should be $428 a share. Now, mind you, if the sentiment surrounding Salesforce changes and they go back back to their historical trading multiple of about, a 91, which is the past 20 years, then Salesforce could, in theory, I'm not saying that it's going to happen, but in theory, could hit $6.36 a share, but I think that's a little too optimistic and looking at things with glasses that aren't your prescription. It's going to be a little wacko. So I would rather say a 35. And so as much as I hate to say it, worst case scenario, they could finish out the year somewhere where they are right now, 244, maybe 250 a share. Best case scenario, I'm hoping they finish out the year. I'm talking about in the next 3 months. So December 31st at about 349 a share, which is kind of in line with the free cash flow prediction and analysis. And at this point in the video, I want to compare Salesforce to all of the other stocks that we analyze on this channel in the past 3 to 4 months or so. If we put them on the left side, that means they're going to be a certified compounder. Meaning investing into Salesforce will 2, 3, 5x your investment in XYZ amount of years. Such as if you put $100 into Salesforce today, eventually, like 5 to 10 years down the road, it should be $200 in a very simplified definition. On the right side of your screen is the CAGR graveyard. CAGR stands for compound annual growth rate. When you bake in the share price appreciation plus the dividends paid out, you marry the two. What is your ROI per year? If a company is placed on the right side, that means it's probably not the best utilization of your capital because the ROI is going to be roughly 3, 4, or 5% year over year. And if it's in the middle, that means they're going to be in the watch list, wait list. I don't have a definitive opinion about the company, meaning I would rather just look at them from afar on the sidelines like the creep that I am, rather than buying into them or officially labeling them as a part of the CAGR graveyard. Now, before I tell you where Salesforce belongs in the compounder chart, let's go ahead and look at the facts. Once again, I'm on the website Finance Charts, and I'm going to be talking to you about their total return. That's the first thing that we should be cognizant of. If we take a look at them in the past 1 year, yes, friends and family, it's a rough situation. Negative 6.5% past 365 days by investing into Salesforce. However, it's because they've just been on a massive sell-off since December of 2024. But if we zoom back and say, you want to say 3 years? If we say 3 years, then you're up by 63%. And then if we say, 10 years? Then you're up by 246%. And if we do 20 years, their maximum timeline on the stock market, then we're working with 4,130% in 20 years. You effectively would have 42x'd your money by investing into Salesforce. So if we take this number, 4,130% total return over 20 years on an annualized basis, then the CAGR is 20.5%. So by definition, Salesforce is absolutely a compounder. Now, if you zoom in and you only take into account the past 12 months, then they're horrific, ugly, disgusting, smelly. Why are we bothering even talking about them? But if you look at them holistically, even just the past 3 years, or 10 years or 20 years, then the numbers are more reflective of their performance. In fact, number 2 about Salesforce, I think this is very polarizing. Some people absolutely hate it, and for me, I'm actually a huge fan. It's that they sustain high growth through inorganic means of mergers and acquisitions. Meaning they buy out the next big thing before it becomes too big, such as Tableau, Slack, Informatica, and innovative AI companies like Convergence and Bluebirds. They grow their top line and their bottom line through buying out the competition. Just like Procter & Gamble with the household essentials products. Procter & Gamble just buys out the next big thing and then they just add it to their portfolio and they continue to just grow and grow. And if you've ever worked at a major company here in the US, then you probably have experience with a Salesforce product. And what I can say to you, if you've never used or seen it before, what Salesforce offers is a pretty sticky software across all of the major enterprises that are operating, especially in the S&P 500. And so they remind me of Microsoft, and I'll expand upon that point later at the end of the video. But just like Microsoft, Salesforce is really beaten up, because if we zoom out and take a look at Microsoft's stock price history, from 2024 all the way to going into 2025, Microsoft was down into the red by a pretty significant amount. Negative 12.5%. But ever since April, Microsoft has rebounded and now they're up in the green. And that's kind of how I think about Salesforce. And here's a fun fact that is pretty interesting. When you think about Salesforce, they hold the biggest market share in the customer relationship management software space, with about 20 to 21% of the market share globally. CRM, that's pretty crazy to think about. And it's not a company that's falling behind in the AI race. I would argue they're a part of the tip of the spear because they're innovating and they're releasing new offerings in their software itself. I think the most exciting thing that's going for them right now is Agentforce. It's basically the AI digital entry-level workers. That's all AI, by the way, that handles the basic FAQ inquiries, customer service questions. They can respond right back to you, doing client follow-ups with potential sales leads, and much more. So not only are they maximizing the output for their clients through these AI agents, but they're able to increase and upsell their services with their current existing clients. So not only do you already have the Salesforce ecosystem in your business enterprise, but now you're willing to pay them a little bit more in order to get Agentforce. So for me, I'm like, dude, that's pretty sick. So all that to say, it's not a company that's just sitting back and is enjoying the product that they created like 10, 15, 20 years ago. No, they're constantly rolling out new offerings and upgrades. That way the customer feels like it's fair when they increase their subscription fee. So when it comes to Salesforce, I mean, you might call me crazy, but I am going to have to put them into the watch list, wait list. Nah, dude, I'm playing with you. When it comes to Salesforce, I absolutely think they are a certified compounder because as we learned from the data, 4,130% in the past 20 years, absolutely a compounder. And right now they're going through a temporary storm because their trading multiple is a 35. Historically, past 20 years, it's around a 91. I just feel like their valuation is way too bearish, especially for the numbers that they are posting and generating. Speaking of which, I'm a numbers and data kind of guy. Let's go ahead and take a look at some of their financials as I talk about my game plan when it comes to Salesforce. I mean, there's no doubt in my mind. If you look left and right at all of the other various software companies, they're being sold off because of fears of AI ruining their moats. But to be honest with you, let's let the numbers speak for themselves. So if right now we're on the income statement and we're taking a look at their top line, which is also referred to as their revenue, look at this magnificent cash generating machine. I mean, in 2016, we're talking about 6.6 billion. As a matter of fact, that's impressive. That's amazing. But you fast forward about 10 years, and now they're working with 39.5 billion. Yes, I think a concern is that the percentage change year over year. I mean, it's going from like 24% down to a high single digit number of like an 8% growth year over year. But remember, they're acquiring and they're buying out all of these various AI companies. So I think their hit in the top line is only a speed bump for right now. Once they integrate those SaaS offerings and products into their ecosystem, I'm imagining that this number is going to increase. And if we scroll on down to take a look at their earnings per share, which is the bottom line per share, I mean, right now it's $6.88. Dude, they still have 2 more quarters to go to hit their number of $6.99 on a very bearish expectation. And actually, let's just look at it, right? Visually depicted. Up until 2023, I would argue very volatile and shaky. Their profit margins were up and down, very unstable. But since 2023, look at how it just increases up into the right predictably, and it's growing at a very aggressive rate. I mean, just 2.5 years ago, they posted 21 cents of profits per share. Between you and me, that's pretty pitiful. And that's why I did not buy into Salesforce back then. I didn't buy into the hype because the numbers that they were posting, what I saw in 2023 is their bottom line shrinking from $4.38 down to 21 cents. However, now that it's going in the opposite trend, I feel more confident in that their business model is more resilient than I previously thought. And if we jump on over and take a look at, I don't know, their balance sheet, I mean, take a look at this for crying out loud. Their cash and cash equivalents is $15.3 billion on the books. That's how much cash they have. Dude, that's absolutely crazy. And that's an increase of 21% year over year. Dude, It just gets better and better. And by the way, I want to give a shout out. I think another software company that's just being absolutely crushed, even though their numbers are really amazing. Maybe I should make a dedicated video for them, but I also think Adobe right now, dude, what's happening to them? Exact same situation as Salesforce. To be down 27.9% for the past 365 days, to have a trading multiple of a 16 based on their future EPS, whereas their numbers look like this, dude, absolutely crazy. I think Adobe, this is not financial advice, but based on what I saw and what I continue to see with Adobe, I think they're great value. Especially when you consider how their EPS is only increasing, their profits per share. Also, their top line is only increasing. So you tell me, does it look like AI is eroding their ecosystem and economic moat? No. However, when it comes to Salesforce, why are we looking at Adobe? This is supposed to be a Salesforce video. I think when it comes to Salesforce, I think they're a bargain deal. If Adobe is great value, then Salesforce is absolutely a bargain. And in defense of the stock-based compensation that some people get their panties up in a bunch about, I mean, to be honest, that's a valid call out. Because on the cash flow statement, you could take a look at their stock-based compensation increasing year over year. That means they're paying their workers, especially at the upper levels in RSUs and with stocks. So it's diluting the shareholders because they're issuing more shares to do this. And for the past 12 months, they have $3.2 billion of stock-based compensation. Dude, that's absolutely absurd. However, to that, I want to say this. If we scroll on down and take a look at their free cash flow, it's also increasing year over year at a very aggressive rate. I mean, for the past 12 months, friends and family. I mean, the data speaks for itself. $12.5 billion of free cash flow. So the free cash flow is increasing, and they're doing share buybacks. So if we jump on over to their income statement and when we take a look at the shares outstanding, look at it. I mean, it hit a high in 2023 of 997 million shares outstanding, but since then it's been slowly shrinking because they're buying back the shares. So in my opinion, because the free cash flow is increasing at a very aggressive rate and they're buying back their shares, the stock-based compensation does not bother me. And according to their last earnings call, the board just authorized another $20 billion worth of share buybacks that the company can do, which means they're going to be buying their shares right now as it's trading for a bargain. And I know it's a very unpopular opinion, but I actually like when a company gives stock-based compensation, especially if they're able to grow their free cash flow to counteract that, because think about it. If the CEO and the executive leadership team, if they're incentivized to look out for the shareholders because their compensation is tied up in stocks, meaning it's in their best interest to increase the price of the shares, that way they can get paid, dude, that means the shareholders and the leadership team of a company, their interests will be aligned in that we both want the share price to go up. Does that make sense? And that's why when I looked into United Health and their CEO came back with a pretty darn big stock-based compensation package, dude, I was stoked. I was fired up. I was like, yes, he ain't gonna get paid unless United Health's stock price goes to the moon. Likewise, that's why I'm a huge fan of Amazon and Google also doing a crap ton of stock-based compensation, because they're also growing their free cash flow at a very aggressive rate while incentivizing their workers to perform in order to make the stock price go up, because the stock price won't go up unless the operations are crushing it. And how do the operations crush it? What's the company's single greatest asset? The human capital, their workers. If they're motivated and their visions aligns with the leadership teams, then it's the best foot forward. So I know that was a very long-winded way to say that I like stock-based compensation. And the funny thing is, friends and family, dude, Salesforce, they pay a freaking dividend. Yeah, the dividend yield, nothing to write home about, but it's an absolutely healthy dividend payout ratio, 24.1%. And this right here is not accurate because the dividend is, in fact, it's growing at a rate of 4% year over year, because it's going from 40 cents every 90 days to now 41 cents. And if you want to look at it visually depicted, oh my gosh, 40 cents, 40 cents, 40 cents, and then there you go, 41 cents. And I wanted to circle back to when I said Salesforce really reminds me of Microsoft. And you could take a look at their operating metrics on your screen as I talk about it. So Salesforce, at the end of the day, when you think about it, created an ecosystem in which a business enterprise depends on their software in order for their operations to run smoothly. You get rid of Salesforce, dude, you're screwed. If in fact you get rid of Salesforce and all of their software for an S&P 500 company, dude, that's going to be a huge impact for multiple departments, such as the sales team, the marketing team, the HR team, the data analytics team. A lot of people use their software day to day. I'm telling you right now from personal experience, once their systems are integrated into a business operation or enterprise, it's practically impossible to switch to the competitor. It's kind of like Cisco. They already have their hands into the pockets of most S&P 500 companies, and they just refuse to switch. Because think about it, if you switch your IT infrastructure and you have a down day of like 24, 48 hours, that's going to be a huge setback for your operation, especially if you are a global company. Likewise with Salesforce, it's just once you're in, you're in. You're not going to lose the contract. And that's why I drew comparisons to Microsoft. Because when you think about Microsoft, I mean, for the longest time, I don't know, from like 2010 all the way to 2018, very boring, but a stable business model of selling the Office products, right? But ever since they made that pivot into the cloud and acquiring Blizzard, and now they're into gaming with Xbox as well, I feel like Microsoft is this huge behemoth. But what I'm saying is, why can't Salesforce also become this huge behemoth based on their very boring software that almost every company uses every single day? Because that's what they have right now, but they're one step away from becoming a behemoth. Or dare I even say a future member of the Mag 7. And I know this is very crazy, but as of right now, I just made a video about the Trade Desk, which is a digital advertising demand-side platform. They're currently experiencing a pickle, and I'm thinking that Salesforce is probably one of the potential companies to buy out Trade Desk. You heard it here first. I think it could happen. Because not only would that open up the doors for them to go into the digital advertising space, but they also have the infrastructure in which they can bake in the Trade Desk into their software. So essentially, it would be a one-stop shop for the marketing, sales, and advertising teams, which would be huge because they usually work together very closely in rolling out, a GTM for the next product or whatever it is that they're trying to sell. Think about it. Not only do you have the customer data, but you will also have the ability to broker deals to have your advertisements all over the internet. So that's what I'm thinking. But I will say this, it's not all rainbows and sunshine when it comes to Salesforce, because to be quite honest with you, I despise their platform and software. Because I vividly remember partnering with the HR teams to screen potential applicants to hire into my team. And I'm gonna tell you this right now, the Salesforce platform, absolutely a headache. It sucks. Now, obviously that's my experience like 4 or 5 years ago. Things could have changed, and now it might be a little more intuitive and more user-friendly, but back then, my goodness, did I not like Salesforce. But taking my personal feelings aside, I mean, just looking at the numbers, it's kind of hard for me to dismiss them as a potential investment, right? It kind of reminds me of Broadcom, in that they utilize mergers and acquisitions to grow into the giant that they are today. They have so many patents across so many different chips and communications equipment, and now they're manufacturing custom semi-chips for AI data players. And that's why I'm saying if you do inorganic growth the proper way, it's a good thing. And I'll leave you with this. Please listen. I'm the guy that bought into the fear and ugly mess, otherwise known as United Health Group, because their numbers and financials looked amazing. Even though everyone else dismissed United Health, saying that this company is cooked, that they're gonna go belly up, dude, based on their fundamentals and numbers, it's exactly play-by-play, line item by line item, what I see with Salesforce, except with United Health, they had a lot of issues happening. Regulatory probing, their CEO abruptly quitting, their industry being shattered, XYZ. Whereas with Salesforce, it's all speculation and the narrative that AI is gonna ruin them as a business operation, which based on the numbers that they're posting, even if we break it down on a quarter-by-quarter basis, yeah, their growth is slowing down, but it's almost at a double-digit pace. So what I'm trying to say is that I made a calculated risk when it comes to United Health because I truly believed that the markets were wrong with United Health. So I plan on doubling down when it comes to Salesforce. I'm going to continue to dollar cost average because at $245, $250 a share, they're way off the inherent worth that I think they are, which is around $335 to $350. Now, it's obviously not the biggest upside. I think it's like a upside of like 34%, but that's still a pretty healthy chunk of change, right? So that's what I personally plan on doing. My question to you is, what are you going to do? Do you like Salesforce? Do you hate Salesforce? What are your thoughts and opinions? Please give me your feedback because I don't want to operate like a crazy guy here. I want to know, am I making a sound decision or not? Anyways, if you took the time to watch the video all the way through, I love you. Stay safe, good luck in the stock market, and I will talk to you next time. Peace.